Okay.
You can record as well.
Thank you.
Right, I hope everyone can hear me. So I think we can officially start. It's 25 to 6. We don't want to waste any more time. So yeah, good evening, everyone. And just firstly, would like to thank everyone for taking the time to join us this evening. For those that don't know me, my name is Matthew Lee, and I'm the co-founder and director of Innovate Alternative Assets and Solutions. And of course, I have the pleasure of being your host this evening. We really appreciate everyone being here, especially our clients, the panelists, and of course, all our new guests. So the goal for tonight is really to give you some insight on why one should consider investing offshore and the key things to look at when investing offshore, such as the timing of doing such investments and the purpose of doing offshore investments, and of course, some options of whom to do these investments with. We will not be providing any financial advice in this webinar, but merely information on why one should consider investing offshore and to allow top 4 institutions the time to present the opportunity to you. But before we have our special guests present the amazing offshore opportunities, we have my partner and very close friend, Anil Governed, the CEO and co-founder of Innovate. He is more of an entrepreneur than a CA, if anyone should ask. I mean, this man has been doing business for longer than I am alive. He is a humble and passionate person and loves cracking things and providing our clients with exceptional service, which I'm sure a few of you have had the pleasure of experiencing already. He has been in the alternative space for many years and has run a few successful businesses prior to Innovate, which is still in existence today and doing extremely well. So Anil, the floor is yours to give us some insights into why offshore.
Thanks so much, Matthew. By the way, you are a little older than that, eh? So, good. One thing in Innovate, we do have a lot of fun. We always trying to test the boundaries at times, but we do have a really good culture and enjoyment in what we're doing. Yeah. So maybe just to start on Innovate side, I'm going to be basically 2-slide introduction. On our side, sorry, Matthew, just go back there. Yeah, so just in terms of Innovate, really, if somebody is earning around 16% annum, 16% annum for 4.6 years, your money doubles. If you're earning, 5 or 6% per annum, it's different. So obviously, this is to do with risk and return paradigm. Yeah. So we always say to clients, really the alternative space is to lift the return. And we share opportunities. We want the client to do their own due diligence and give them sufficient time, and then they make the decision on which way they would like to proceed. But, it's important to be vigilant on the performance of the assets. Sometimes clients, they get so busy, especially we deal with a lot of entrepreneurs. 60, 70% of our clients are entrepreneurs. Average age of our clients are around 55. And you find that people get busy in their own lives and they're not vigilant on the performance. And really, if you want to work less or you want to have options, when you're going towards 60, 65, it's important that the assets actually, you do sweat your assets. Yeah? Only 6% of South Africans can retire, which is really very alarming. And it's very, for me, it's disappointing that our country is sitting in a situation where majority of people can't retire normally at their retirement age. Yeah. Next, guys. So just in this one, we're not going to focus on all the other opportunities. We are tax structure specialists. 28 years as a CA, and our team is pretty strong. We've now partnered with Naveen Ramlakan. He's an ex-partner at Price Waterhouse, and he's joining us at Innovate Fiduciary to do the tax structuring side, estate planning and tax structuring side. It's really a big area for us. For me, how you house your asset is as important as the return, because if it's not tax efficient, if it's not good in terms of succession, you're just creating a problem for your beneficiaries. So yeah, tax structuring is something you can engage with us, especially if you haven't structured properly. So we have property opportunities. Obvious is a property opportunity in the international market. We don't really do any properties in South Africa at the moment because of the political environment on properties, and yeah, and also some of the issues in South Africa in terms of the economics and the environment where there is risk of neutral or negative growth. Yeah, capital depreciation instead of appreciation, you can have capital depreciation. Yeah, possibility. So properties we got to look at. We like two property opportunities. Obvious are the one that's presenting today. We also like a property opportunity in the UK. We also do funding opportunities. This is alternative assets outside the mainstream. So it's not like the usual, unit trusts and stuff like that. We're more focused on the alternative assets, private equity, lending assets, business opportunities. And recently, we also started a private equity company. Next, guys. So when it comes to offshore, that's the introduction done on Innovate. We're moving on to offshore now. So for me, the principles and process is a very important thing, and I'm going to focus on that in my 10, 11 minutes. So the starting point is that, firstly, you've got to choose foreign currencies that are stable and hold value over time. And you can diversify. Recently, there has been thinking about do we buy Japanese yen? But the main currencies in the world are GBP, that's the pound, euro, which is euro, and then USD, which is US dollar. But yeah, there's also room to focus on economies that are growing and some emerging economies. Even the Indian rupee is doing a little better than what it did before. So you can diversify. However, you find most clients want to stick to the three main currencies, and USD, just because of their past, the whole history of USD, people sometimes still stick to that. But I always say to them, look at diversifying your currencies also and the investments in the different currencies. Yeah. The second part, when you look at offshore, we have simplified the process. So, there's nothing to be worried about if you want to execute on an offshore opportunity. However, when it comes to the due diligence, we want clients to look at what are their pre-requirements, what are their due diligence requirements. So they need to do that properly in relation to their lifestyle, the circumstance, and their risk appetite. That's a very important thing because offshore also has issues on on the estate side. You need to know that you've covered that. And I think risk appetite is in relation to your total assets that you have. And we allow the client to make that choice. And the last thing is, obviously, if you're doing a higher quantum in offshore, there's options to do offshore structures. We have parties that do that in 2 or 3 offshore jurisdictions. Yeah, it's not as easy as doing a transaction yourself in your personal name, but it is good if it's structured well. And tax in Mauritius in a offshore in a GBC, it's 3%, and places like Cayman Islands, Dubai, the offshore jurisdiction areas, some of them are no tax. So as long as it's done with compliance, you have a good chance of saving on the tax. However, why we say when the quantum is higher is that there's a cost of running. It could be $3,000 to $4,000. Some of them are a little cheaper. Some of them are a bit more expensive. Mauritius, I find now a little bit more expensive. And you've got to have at least $300,000 if you want to do offshore structure, although you've got a saving in tax. Next. So today I'm focusing on the why. I always say to guys, before you even think about what offshore opportunity, think about why you want to do offshore. And for me, we've summarized this in 4 points. Firstly, the rand has depreciated, 200% against all major currencies. I'm going to share that in the next screen. You want to leave a legacy and heritage of significance in global terms, because you may have, a lot of value in assets in rands, but if the rand goes south, I'm just saying, right now it's 14. Let's say it goes towards 20, 25. Last year you saw it tipped 1927, but it normally comes back. So, if the rand moves towards 20 to 25 and upward, then you actually, you're halving the value of your estate in global terms. So really, the idea of doing offshore is not something you just start very late in your life. It's something, especially the younger folk that are on this call, really think about it and make a start, and you learn as you go. But yeah, there's nothing stopping you from starting. Some of the minimums are quite low, like OPES is $5,000. I know with high-sec, the offshore is a little bit higher, but you can, if you have a company, you could do it with lower values. So all of that can be thought about. So leave a legacy of heritage in global terms, because it's quite likely that your children could be, studying overseas. You could be having your kids are going to live overseas. There's no use giving them something in rand if they're living in the UK. Yeah. Third part is really something that's my favorite thing. Yeah, I really live for experiences more than material things. So if you do foreign investments, you also got a chance where you're earning in foreign currency, and it will allow you that affordability to travel to your favorite international destinations. Yeah, and I think people that love experiences, it's really one of the reasons why you should be doing offshore. And then the last one is retirement lifestyle options. I said deliberately retirement or lifestyle options. So one is retirement in global destinations is something a lot of South Africans don't think about, but yeah, it's something you can think about. You can also have where you can have a usage in a country like Portugal, have access to Europe with that, etc. Where you spend a few months in the international destination and you spend most of your time in South Africa. It also can be 6 months and 6 months. Yeah. Yeah, and those are the four things to be summarized after looking at various other smaller ones. Yeah. Next. So this is a good slide because people don't understand a 200% depreciation in the rand. Justin. So the rand depreciation, the USD has moved from 6.57 to 14 rand 6 cents. Obviously, the peak was 19 rand. But just on the normal one right now, the rand is really strong in the last. It's the strongest in the last 16 months. The last time it was at these levels were December 19. It dropped in December 20 to 1450 levels. But I mean, this is an opportunity to buy a tranche. You don't have to buy all your offshore, but you can definitely look at considering buying some tranche. So to give you an example, a million rand that would have given you $152,000 in 10 years ago. Now it will only give you $71,000. That means right now the value today is 46% of what you would have got 10 years ago. And the same thing in the euro, a million rand would have given you 104,000 euro 10 years ago. Now it will give you 58,000 euro. So if you ever have any of those four Ys that we covered in the first slide, it's just going to cost you more in rands. That's a simple fact of that. And GBP, from 1066 to 1992, the peak of that was 24 to the rand. So a million rand, they would have got you 93,800, and today you would get 50,200 at today's rates. Yeah. So that's 53% of the value you would have got 10 years ago. So on average, whatever value you had in rands has halved in global terms. That's approximately halved in global terms in 10 years. I just thought this is a good slide to illustrate it because some people still don't understand what the effect of a depreciation on the rand is. And this is why some of the houses offer a lot of guarantees when they have, guaranteed products linked to an index. They give you a guarantee because they're also banking on the rand depreciating over the 5 years. Next, please. So just to summarize that, the effect of all of this is the diminishing value of the long term. Effectively, your wealth has halved in global terms. That's only in 10 years. If you take it in 20 years, 30 years, you can obviously do that. But just in the last 10 years, yeah, whatever you had is just halved in global terms. And that's something to really be serious about and have a plan of action, as to how you're going to address that. Offshore, firstly, for a lot of people, for some reason sounds very complex. And you've got to start somewhere. You've got to educate yourself. This is the start. Like you're coming for a webinar like this. Sure, there's a whole lot of other ones that you could also join, and that's how you educate. And then you learn and slowly, look at what resonates with you, what risk profiles resonates with you, moderate risks, moderate high risk, low risk, and then start choosing assets in relation to that, and things like liquidity. Unlisted assets are not as liquid, but if you have a unit trust, it's much more liquid. So all of those factors come into play when you choose your asset. And the second part is that if you have rand depreciation, you're going to have limited international choices in terms of travel. If your children studying overseas, if they're really pushing you on that, and lifestyle retirement options, the lifestyle like usage options in the international environment. Next. Hope you can see this. I actually put this in a bit of a narrative rather than a point. Some people read sentences better than words. So this first point I want to reiterate. So the first thing is, based on your circum, decide what percentage you would like to hold in offshore currencies and offshore assets. I always find that's a good place to start. If you don't know what you're going to own in offshore assets, so you haven't thought about your why, obviously, if you're an older person and you're never going to leave the country, then the percentage can be a bit less. But if you definitely want to emigrate, or you're a young couple that had a child and you just don't want to bring up that child in this country, then that percentage is more towards the 40%. So that percentage, you got to decide that, and based on your why and the circumstances around you. And once you get that right, then you can choose the assets and the asset classes and specific choices. Yeah. Until then, you just kind of, it's as good as a dartboard. You have to agree that quantum of what you're going to do offshore. I always find that's a good time to start. Yeah. Once you decide that, you give yourself the time to do your due diligence, build your offshore portfolio selectively and slowly over a 24 to 36 month period. It's not a short-term thing. You start with some things. You can also put your toe in the water on some investments offshore and see how you find it. And then you build it over the medium term, medium to long term. And in terms of asset classes, offshore. Similar to South Africa, but you get listed shares, you've got ETFs, you've got unit trusts, you've got property, like obvious is property. Private equity is Loop, for example. They're based in Gibraltar, but private equity is invested in Europe and UK. Impact investments, something that Magda from Signia has left to do, one of the areas that she wants to focus on, and private equity. And recently crypto assets, even if on a super high risk, nothing stops you to say, let me look at 1% of the assets. And crypto has had a nice dip right now. Buy on the lows, don't buy on the highs. That's what the mistake happened in 2017. So yeah, on that side, limit it to a very small percentage, but it deserves some attention, and it can give you a return if you're quite clever as to when you invest. Next. Okay, and then, sorry, one back, please. Yeah. So I'm going to shoot through this here. Some of this was covered in the email. So, offshore allows you geographic and investment diversification compared to only doing stuff in South Africa. You can buy the best companies in the world rather than only South African companies. You can earn in foreign currencies. You can also buy the currencies in tranches, which I mentioned earlier. So buy when the ZAR is strong. So just to finish off there on the last slide. Next day. Okay, so the 4 opportunities, I think you're all aware. Obvious is a medical property opportunity in the USA, renting properties to professionals mainly, but focus on the medical sector, professional doctors mainly. Loop is a private equity in Europe. Matthew will give a small introduction before each presenter shares the opportunity. Sasfin Wealth, we deal with David Shapiro and Craig Diesel, and now Nicholas Soro and Michelle Bester. They have a different strategy and very interesting one, also including other assets besides just normal listed shares. And then HiSec is a company we're working for the last 3-4 years, and they've been doing offshore unit trust portfolios in relation to our clients. So they are FSCA house. Next, guys.
Okay, I think I'll take. Yeah, thanks a lot, Daniel, for the time. I can see how passionate you are about it. So for us to get into the next opportunity, I'd like to start with Allvest. Allvest, just to give some background, it really makes it easy for South Africans and 20 other countries to invest in medical commercial real estate in the USA. Over the last 6 years, Allvest has distributed strong cash dividends averaging around 8% on a quarterly basis to investors and have facilitated long-term wealth creation for their clients. So to present Allvest, we've got Justin Clark and Martin Freeman. Justin Clark is an award-winning serial entrepreneur, mentor, investor, and innovator, and is passionate for real estate. Something interesting, he co-founded the private property portal in 1999. Under his leadership, it evolved from a real garage startup into a leading internet marketplace for real estate in South Africa today. I'm sure some of you know. Martin Freeman, who will be presenting with Justin, is the CEO and is a successful entrepreneur with over 30 years of success in business startups and growing companies to a significant scale in various industries that include financial services, lending, the fintech space, and now in the real estate space. So Justin and Martin, the floor is yours. Thanks.
Sure, Matthew, thank you very much for that very generous introduction. Guests, thanks for attending. It's a fantastic turnout. Anil, you've managed to really pull it together. Yeah, really appreciate having us online. I think time is quick, time is short, and so let's get quickly into it. We're very pleased to have Martin here from New York, and he is about to jump on a train to go through to Manhattan for a meeting. So we'll let him get going and introduce and tell you a little bit more about Allvest, the company, what we do and why we do it. So over to you, Martin.
Thank you very much. And so, maybe a starting point would be to Anil and Matthew. Thank you so much for hosting this tonight and for allowing us to present on Allvest. Just a very brief introduction. Where did our story start and who is Allvest? And it's important for people to understand that we were exactly like your attendees tonight. We were in South Africa. I'm a Durbanite, and then spent time in Joburg. And we wanted to just invest our money, our entire executive team who didn't know each other, into a safe, secure environment offshore where we could sleep well at night. And we'd always been told by a lot of the big banks and institutions in South Africa, be thankful if you get 5, 6, 7% in dollars or euros or pounds. And the reality is that when we started to seek solutions, we came together as a team. And as you've heard now, since 2014, we've been helping South Africans and people around the world invest into real estate. And if we can go to the next slide. Just to explain exactly who Allvest is. We're a global real estate company that invests with a hyper focus into the healthcare niche in the United States and then raises equity from around the world. And Justin's going to discuss why specifically the healthcare space. Because when we started, we were doing exactly what most people do. You do multifamily, you do houses buy to rent, and various other things. And we settled on a niche that we felt met most people's expectations. And so just to take it a step further, fast forward 7 years, Allvest is now a company that raises equity from over 10 countries in the world and has investors from over 20 countries. Our portfolio is now exceeding $340 million. We have 1.2 to 1.3 million of square feet under management. Our total cash and cash, as you heard, is 7 to 8% on a quarterly basis that we pay out. And then our total returns, which we'll discuss a little bit later, is 11 to 17% per annum. And you can invest from as little as $5,000. I think what makes us also so unique is that we really have a driving desire to help people in South Africa and other countries. And so we specifically have our entry level at $5,000 so that it becomes affordable for anyone to pretty much start that journey of offshore investing and understand that it's not so difficult when you step your foot into it. Next slide. This really just gives you a feel of our medical buildings, what to expect. So whether it's in Joburg and it's Morningside or Linksfield, or whether it's parts of Cape Town or in Durban, some of the places there, around, the Berea, it is a typical building, multi-tenants in it. So that reduces your risk. These tenants obviously have long leases. And as you can see, they are sizable assets, sizable buildings, and they've been there a long time and will continue to be there a lot longer. We only invest in specific states to make sure that the money is protected, because preservation of capital is everything to us. And without further ado, Justin will take over and start speaking about other components of this. Next slide. And before we just move on to the why, the most important thing is when you invest offshore. For us, it's super important that people have a sense of comfort as to who they're giving their money to, and that their money is going to be safe. And so for us, we believe very strongly, we've only got one reputation and we protect it at all costs. We won't do buildings unless they are correct and appropriate for our investors all around, and that they're safe. And so you can see that we've developed within the business a strong culture of compliance and governance from the board. And you'll see we've got guys from the US in terms of James Saperstein, who's taken a number of companies in biotech, etc., to the NASDAQ. We've got Darren Jacklin, who is known and has certainly played a leading role in a number of Fortune 500 companies. We've also got Bharat Mehta, who some of you may know from South Africa, who is certainly a significantly known individual with vast experience in real estate and growing companies. And then we have our team, and I'm just going to fly through on the right-hand side. We've got people involved in some of our committees who have been involved in setting up India on behalf of some of the big institutions in South Africa. We've also got Eric Gonzaga, who is part of Grant Thornton America and heads up their compensation division. So that gives you a feel of the size and the critical mass of the business, and that we just encourage everyone and say there are options available. Justin, over to you for the next slide.
Thanks, March. You can change Jayshree. So I think the big question is, first of all, why? Why medical? And I'm going to start off by talking a little bit about the geography of medical. So if you think about your local doctor or dentist and how long they've been in the premises that you've been visiting them in, generally it's pretty tired and the magazines look old, but think about how long that doctor has been there. The one thing that is very unique about medical is that doctors like very long leases, especially the heavy medical that we focus on. Things like radiology. It costs an enormous amount to equip a premises for radiology. So these doctors like to have very, very long leases. And what is good for us as investors is it means that you know that you've got a coupon clipper. You know that it is a very high probability that they're all going to pay their rent, and they're all going to be there in 10 to 15 years' time. And this is what really excites us, and why we like this particular sector. I must say, when we got into it 6 years ago, it was relatively unknown. In fact, it was just sort of bundled together under commercial property. And today in the US and in other parts of the world, I must say, it has become the flavor of the month, obviously because of COVID, and medical centers generally had to work. So, I think that's the first a driver of what pushes us to medical. The next question is, why do we go into the US? Well, the US operates very much like South Africa. They have a private healthcare system. More than 80% of the population is on private healthcare. So you can see from the map here that we have a specific group of states that we particularly like. And some of the fundamentals are very fast growing population, very fast growing economies in terms of GDP, and landlord friendly. It's very difficult to operate in a state that has very high property taxes, and it's very difficult to get tenants in and out in the event that you need to. So you'll see the dots coming around. In fact, we have a property in Florida now, and the other aspect is and I'm going to get to the next slide, but look at the smile or the yellow dots that form across the bottom of the US. These are the warmer climates. They do tend to be more tax efficient climates to operate in, and people in the colder climates tend to move to the warmer climates where their money will go further. You've obviously heard of Florida as being the retirement capital of the US. Well, it's not really. There are a lot of other states that also attract a lot of retirees, specifically Arizona, and a lot of people settle in Texas. So I think you can get an idea of where our buildings are and where we are acquiring buildings from this particular map. Thanks, Jayshree. The other thing about the US and about medical is that you have this aging population. And interesting. If any of you are getting a bit older, you notice you tend to visit the doctor, which you didn't do before. The demographic over 65 tends to visit the doctor or spend more than 5 times on medical services than those below. And it just so happens in the US that around about 2030, the population that will be over 65 will be in the region of 80 million people. And those 80 million people tend to be more affluent than the younger generations. They're the boomer generation, and they will pay for medical services regardless. One of the things that's super interesting, and Jayshree, if you change, I can tell you a little bit about the other thing that's interesting. People ask us why medical office buildings and why not hospitals? Interestingly, there's a trend out of hospitals. And if you think about what's happened in this remarkable advances in technology, you will find that that you don't need to go necessarily to the hospital to have an X-ray. You can go to your medical office building because the X-ray machines are smaller, more compact, and more advanced. You can go for an operation where you have microscopic knee surgery, and you can walk out of there in the afternoon. You don't have to spend 2 nights in hospital. So, I think you can see from this graph that there's a trend away from the hospital system. Jayshree? So this is how we see it in the US. And obviously this is a simplistic view. I know, there's going to be some people on the call here that will be able to argue this slide. But interestingly, at the end of 2020, we looked at the performance of the market. Admittedly, it wasn't a great year. The first bar on the left-hand side is the US REITs index, which effectively, putting it simply, it includes the capital value. So how did you stand if you'd invested money in January 2020 compared to how you would stand at the end of 2020? And effectively, the whole index moved backwards by about 5%. If you're a safe investor, then you are probably going to look at having some of your money in US 10-year bonds. And you can see they are performing particularly well at 1.63%. US listed property, 3.38. That's across the whole sector. And now remember that these are not including your capital appreciation or depreciation of your share. US healthcare did a lot better at 4.42. And our offering is, and I just must be clear, we have 2 different offerings. We have our traditional offering where we acquire a single building. We list that building and we allow you to buy shares in that building, which is completely ring-fenced from any other building. You know what you're buying. There's nothing that you don't understand about the building. Everything is completely transparent. You know who the tenants are, how long the leases are, etc. Then we have a diversified product, which earns a slightly lower interest at 20%. That means, what is that, about 1.75% per quarter. And that one is a minimum of 8 different buildings. And I'll touch on that later. We have had some exits because our investment period is 5 years. And the first 3 exits that we had, all of them way above 10%, in fact, 11.3 and 11.5. Now, 11 to 13% in the US is really a great return. And certainly that is net of taxes. That is after we've paid the US taxes to get the money out. So I think that's very interesting. Thanks, Jayshree. And I'm going to bring Martin in to talk about this slide. And this is the performance of our portfolio.
So if you can just hit enter one more time. Thank you. And so as Justin mentioned, as we start to approach the closure of Who Allvestors in our presentation slot, what we really have is buildings that have strong fundamentals. They're in good locations. They've got tenants who have generally signed anywhere from 5 to 15-year leases. They're profitable, they're well known. And so you can understand how the value proposition is actually quite low risk and very safe for people. And so what we do is we gather the money around the world. We go and find one great building after another. We invest, and you can see our track record over nearly 7 years now. We thankfully haven't put a foot wrong. During COVID even, we outshone most other sectors in the world. As you know, logistics, online, healthcare did very, very well, conversely compared to other sectors. And so as Allvest, the company, we really are very proud of our track record. We continue to propel moving forward. And remember, people can even invest from $5,000 into our ODH product, which is the diversified holding product, which then goes into 8 investments of ours. And so you can see that we believe we are well poised to assist people from around the world. And I think the most important thing is that, just as Anil would say, and we say, You know, it's not complicated anymore to move into offshore investing. Previously, it was very difficult and very complicated. And so we've all worked it out. We've got good systems and platforms. And so off the back of that, people can get in simply. And that moves over to Justin for the last slide to really talk about how you would invest with Allvest and our platform. Next slide.
Thanks, Martin. Yeah, it is super easy. We try to make it as easy as possible. I think the most complicated thing that Anil and the team at Innovate will understand is KYC. When you are moving money internationally, that is probably one of the biggest challenges. But apart from that, we have a platform where you can manage and operate your own investment. However, we are a registered financial services provider, and we do have consultants in South Africa that can help you along the way if you do need help. But the beauty of it is once you made your initial investment of $5,000, in fact, you can invest $1. So it is really flexible and does provide for you to be able to put a little bit offshore on a regular basis, on an ongoing basis. Thanks, Jayashree. And this is just our almost final slide, I think. I thought I would just touch on ODH4, Anil, for the benefit of your investors. As we mentioned early on, this is a mini fund, although obviously we can't categorize it as a fund. It is listed in the Seychelles. It has a 5-year maturity date. The value of it is only $4 million, and it is running at the moment. We have a minimum of 8 of our own investments that are already profitable. So these are buildings that we know that are already generating a return that we then invest in from this particular company. So it's a conglomeration of investments in our existing profitable buildings. So it's an absolutely known and safe entity. And if you have a look along the top, I'll give you some of the details. Let's look at the yellow column, investor return forecast, and go to number 2, cash flow. And you can see from when it started, it pays $350 for the first 6 months per quarter. And that is paid out as a dividend. So obviously that's a lower tax than you would pay on interest. And then it jumps up to 7.5%. So that's 7.5% pretty much secured. And over the period of the 5 years. Now, what happens at the end of the 5 years is as those buildings mature and we get to sell them off, because we have to sell them off, that's our mandate in 5 years, we get capital growth in the building. And the capital growth is baked in, just like in South Africa. The rentals mature, we fix the rentals, we move out commercial tenants and make sure the building is fully medical, and it appreciates. And here it is, the appreciation here, you can see there's a nice capital growth. The capital growth would give you an additional bump at the end, which we share with you, and that takes you again over the 10%. So that's basically what our Allvest diversified holding is. It's something that Anil has particularly liked out of all of our products because it is safe and it's secure, and in fact the return is almost the same as some of our core single buildings. So that's it. If you've got more of a risk appetite, then you go for the single buildings. But as far as we stand at the moment, this is certainly Anil's favorite. So I think that's about it, Jayashree.
Thanks, Justin.
Thanks very much, Justin and Martin. Next, I think just to also move on, thanks for taking the time there. Let's get into Valoop, the Social and Financial Impact Fund. Valoop is a social purpose investment business based in Gibraltar, the UK, and now recently in South Africa. The investment team behind the Valoop Fund bring a combined experience of more than 150 transactions to generate high investment returns with positive and sustainable social outcomes. They've managed to redesign the additional private equity toolkit capable of bridging the historic gap between capital markets and the SME funding demands. To take us through their offering, I'd like to introduce you guys to Stephen Greenwood and Chris Benfield, who have stellar track records in the private equity arena in both the European and South Africa asset management industry. Through their partnership, they provide the South African investment community with the opportunity of investing in high quality European SME businesses. Thank you, Stephen and Chris.
Yeah, thank you, Matthew. Thank you, Anil. I just want to echo the other sentiments. You know, what a great event to be part of. And yeah, thanks for the invite. It feels like speed dating, Anil. You didn't really give us much time. but nevertheless, we'll try and move through it quite quickly, and I'm sure there'll be some questions a bit later. It feels like I've been in the investment industry forever. I think the hairline shows for it, and just to introduce Stephen, he'll jump in at the end. So I think he's probably been in longer given his hairstyle. So it's great to see Stephen. Stephen is in Spain. I'm in Johannesburg, and it's really been an exciting journey for me personally to be involved in Stephen and the Valoop team now for over 2 years, and it's a wonderful opportunity to be able to share the story with you. I think all the speakers, it's from the looks of things, we're all complementary in some way, and it's wonderful to be representing an alternative strategy, particularly in the unlisted private equity sector. I think it plays a magnificent role in many portfolios, and hopefully you find our story interesting and continue the conversation from here. So just let's kick off with performance, because it's always a good story. Stephen started the business in 2010. The fund launched in 2015, and it's given us a wonderful, in terms of compound annual growth rate, of almost 15%. It's worthwhile noting the fact that COVID, like all asset classes, have been impacted by a really unprecedented pandemic, and it's no surprise that this portfolio has also had an impact during that period. But it's been incredible to see the management teams of the portfolios that we've been invested in react. They've been flexible. The SME asset class that we invest in really provides a robust access to many markets. And it's been very pleasing to see many of the portfolios have actually held up. And you'll see that the estimates for March, they are estimates that they're pretty much baked into the cake. We've seen an incredible recovery coming out of December 2021. So this year is looking incredibly good for the portfolio. There've been no particular issues that we're worried about, and the recovery that we've seen coming into Q1 is incredibly pleasing, and we're seeing that we're really back on trend. So a really good long-term story that we're proud of, and I'm going to take you through kind of some of the investment thesis that the fund invests in. So next slide, please. So one of the opportunity set that the Valoop business looks at is the mature SME asset class in the European market, and an asset class that is able to provide a significant contribution to economies. I mean, you've seen, I think it's probably well known that the SME asset class, or the small medium enterprises, they represent up to 99% of all businesses in the economies. Significant employer, 60% of all employees, and collectively they contribute over 50% of GDP. So collectively a very important asset class in many, many economies. People, focus on your very much large cap counters because they got the brands, they got the representation in the listed market. But as a community, the SME asset class is a significant contributor to all economies. The one thing that we're finding, though, is that the mature SME asset class within Europe is reaching a point where many of them are needing to sell. So the research that the team has done, and the research that many of the regulators in Europe and the UK have done, have seen an incredible amount of businesses coming up for sale. So they estimate that about 7 million SMEs need to be sold by 2030. You're starting to see PLCs, particularly after COVID, looking at their structures and simplifying their businesses. And they're considering the sale of non-core SMEs in the next 2 years. Also, very much public research. This represents close to £519 billion worth of value that many family SMEs, that's 85,000 a year, that need to be sold in terms of what the research is showing. Because many of these, the businesses that we look at are 35-year-old businesses. We're probably all familiar with them in terms of the businesses that we're engaging in South Africa. It's no different in Europe and the UK. An incredible amount of businesses that are up for sale. However, there's a problem. Next slide, please. However, the model is broken. So what happened after the financial crisis in 2008 is that many of the banks and private equity businesses exited the market. And what you found is that there's absolutely no solution in the market for these SMEs. Incredible amount of demand, as we said in the previous slide. There are 1,000 SMEs looking for a sale a week in terms of the stats we see. So we're inundated with a huge number of opportunities that we're looking at. High quality businesses that have been through many recessions. We've seen it in terms of the performance in COVID, how robust those businesses have been. An incredible amount of businesses. However, there's no solution. The banks have in fact forgotten about the SME market. They most certainly don't lend to them anymore. Your traditional private equity market has exited. Stephen can tell you many stories about the world that he operated in before 2010. Him and the team did 150 transactions before the financial crisis. The financial crisis hit, liquidity dried up. Many of the private equity firms started moving up to the much higher ticket value items. You've had a broker community that's been established as this need to be able to sell these SMEs into the market. So the broker community has grown. However, they don't have the skill sets to be able to provide the SME with various options. And the one important thing, which is a key component of the Valoop value proposition, is that many of the SME owners, in fact, most of them, would like a buyout option that involves their employees. So the Valoop fund has an incredible social angle to it, as well as an economic angle. So it allows the SME owner the option of providing their employees and the management of the buyout option. However, their options are very limited. And as a result of it, you see many transactions failing, long drawn out processes. And in fact, it's created an environment that's perfectly suited for the Valoop value proposition. Next slide, please. So to give a slight history lesson, I've alluded to some of this. In 2010, Stephen and the team did, as I mentioned, about 150 transactions. So an incredible amount of skill and experience. But that team didn't exit the market. What they did is that they reimagined it. They redesigned the buyout model. They said, how do we in fact improve on the buyout models that were traditionally used? But Stephen will often say that the model was inappropriate for the SME asset class. So they reimagined it. So it wasn't something that was an overnight kind of, let's just kind of do a knee-jerk reaction. Let's just start a fund and start replacing it. They in fact reimagined it, and they launched the fund in 2015. And I'll take you through some of the unique features within the fund. But they've rebuilt the buyout model. They've added 6 financial products. So the whole funding mechanisms have been added to the fund, and this provides a blended return, both debt and equity in the portfolio. I'll show you a bit more detail a bit later. And what we have found since 2015 is that the portfolio, as the performance numbers have shown, has effectively provided a great starting point. The first iteration of the strategy was done through a private investor fund, which we recently converted in 2020 to an experienced investor fund. Now that has allowed us now to scale up and in fact start servicing the opportunity set that I alluded to right up front. At the moment, they're in the region of about 9 portfolios in the business, doing incredibly well, but the target of this fund is to at least start making a difference to 250 SMEs. So very ambitious targets. And it's also driven by a need to make a difference in society. So many of the portfolios think about it as single owner, but society actually needs multiple owners of these portfolios. So it's a great opportunity for the Valoop story to start making a contribution to society using employee ownership. So employee ownership is a key theme. So we need to find a mechanism to incorporate management and employees, but yet still find a return for investors. And Valoop has managed to find that solution. Next slide, please. So what the Valoop solution does is that it effectively provides the SME owner with the option of the most preferred buyout model. So it doesn't want to do a trade buyer. He wants to effectively sell the business to his management and employees, leave a legacy, remain relevant in the community that he is. So it ticks the box. So it's a win for the owner. most certainly is a win for the employee, because employees right now, with the fact that the banks are not providing funding, mean that the employees are not spoiled for choice. So it's a win for the employees. So the employees and the management teams have the ability now to own their business, which is good for society. And in fact, it's good for investors, because suddenly you've got an energized management team. They've been sitting with ideas that suddenly when the owner of the business exits, suddenly this management team is reinvigorated, and you find that the growth rates of these businesses improve significantly when the employees start taking over. I'll get to investors in a moment. So I've mentioned the fact that communities, many of these businesses are important components in the communities that they operate, and the fact that you don't do a trade by everything is, there's continuity in the performance of this business, the operations of this business, so there's very little impact to the community that it operates in. You've seen many examples of trade buys where the head office needs to be relocated and businesses need to move. And as I mentioned, is that the businesses also start performing incredibly well. And this package of providing investors with an opportunity to contribute to changing society, this word democratizing capitalism, is an important component, but it's not at the expense of returns. You've seen the returns of this portfolio. So the Valoop solution provides the liquidity, but in fact provides investors with a return as well as an opportunity for an employee base that has very little opportunity to invest in a business, to own it. Next slide, please. So we spoke about the 6 products, and this is the unique feature. So many of the traditional private equity businesses would focus purely on the equity component, and they would use third-party debt. Now, as Stephen from 2010 reimagined the solution, they said that a blended outcome where you have no third party involved in managing the funding stack, and the ability to provide equity and debt in the same solution, in fact provides the unique value proposition, which has a number of benefits. First of all, it's much easier to execute, so it's a lower cost to implement. There's a single due diligence process. Can you imagine it if you had a bank or another private debt provider involved in this? You'd have to go through a number of due diligences that all have a requirement for excessive security. The fact that we were able to manage the stack of funding through one single process allows us to manage it much quicker, avoids managing risk differently with different providers. So the ability for a single process definitely drops costs, but it helps us manage risk in a far better way. The one important element for investors is that you are investing in equity in the portfolio. However, because you've got this blended stack of solutions, allows us to provide liquidity, which is a very unique feature in a traditional unlisted proposition. The fact that a lot of the senior secured debt comes back to the portfolio gives us access to liquidity that we can utilize for liquidity calls if necessary.
Hi, Chris.
So next slide.
2 minutes, guys. Yeah.
Sure. Next slide. We're almost finished, yeah. And our portfolio is diversified across multiple sectors. It's not sector specific. We're proud of the fact that we're able to provide the solution to many sectors. If there's an opportunity, we can drill into these sectors when there's time, and specific examples we most certainly can give. So I just want to provide a minute for Stephen to talk about the future pipeline. So if we go to the next slide, I just want to introduce Stephen, who's the CEO and founder of Valoop, and he most certainly can give us a sense of the future of the business and how potentially investments would be deployed going forward, and maybe some closing remarks.
I thought that was great, Chris. Afternoon, everybody. I thought that was really well put today, Chris. Just on the employee aspect and the importance of the employees in a democratic, as you call it, transparent ownership, so they share the profits. I did just very quickly. I did a talk about what came first. Was it the alpha or was it the inclusivity? And everyone on the course got the question wrong. it was the alpha that had to come first. We had to be in a position to provide all of the financial products in one house for all of the 6 different products, and financially and equity engineer the transaction so there was a high alpha before we gave equity to the employees. But having the employees is, that's probably where in the US they would call us impact private equity. And I don't know, Chris, where anyone would settle on how you label the loop. Is it impact private equity, or is it private markets collective? Because it's got debt, equity, asset finance in it. But that's for another day. So yeah, pipeline is building now rapidly. You're right about the numbers, Chris. Thousands on a weekly basis, and statistically, there's 57,500 SME business owners in Europe that are celebrating their 65th birthday party every month. Yeah, 57,500 SME business owners reaching 65 a month. Reminds me of what Justin was saying in Northwest about the market, medical market, because of all of the baby boomers. It's exactly the same age demographic, slight, obviously different strategy. So we're super pleased to talk about everything today, and I'll thank you very much for the invitation.
Thank you very much, Stephen. And Chris, we really appreciate it. Sorry, it was still another slide.
No, that's just a summary of what we've covered. So, I mean, I think if you're going to distribute it, I mean, I think the key takeaways is that clearly as an alternative asset class that's uncorrelated, there's an enormous opportunity within this mature SME asset class, as we've said, using an employee ownership mechanism, invigorates energy, drives returns, and together with the skills and experience of the Valoop team, we've seen the history in terms of how we've developed social outcomes as well as economic returns.
Awesome. Great. Appreciate the time, and you're really good. Thanks a lot, Stephen and Chris. We appreciate it. And just to move on with time, I hope Nicholas can keep it a bit shorter. Would like to introduce Sasfin. So we've been working with Sasfin for some time, and Sasfin Wealth has provided obviously trusted advice and wealth management solutions to many of South Africans' most highly respected families and established organizations for over 125 years. Tonight, we're going to talk about the offering, which includes bespoke, segregated, global and local equity portfolios. They do unit trust, pooled portfolios, and structured solutions. To present Sasfin Wealth, we have Nicholas Suru, who is a senior portfolio manager. He has 16 years of investment experience at Sasfin and has helped create financial freedom for many of these clients. He's also passionate about the financial markets, and what he enjoys most about his job is interacting with clients and building wealth for them. He forms part of the investment committee. He chairs the infrastructure asset class subcommittee and specializes in the global diversification. Joining him is Michelle Bester, who is also a senior portfolio manager and has managed clients' personal wealth locally and offshore for nearly 2 decades. What she enjoys most is also client relations and offering them innovative solutions to grow their wealth. Michelle also forms part of the investment committee and subcommittees at Sasfin, which ensures clients benefit from opportunities across all the global markets. So Nicholas and Michelle, the floor is yours. Thank you very much. Jeshri, can you move to the next slide? Here we go.
Great. Well, thank you very much for that. Good evening, ladies and gentlemen, and thank you for that introduction, Matt. I really appreciate it. We're going to be fairly brief. I see time is running out, and what I'm going to be speaking about today and touching on is the growth options that Sasfin offers for our offshore portfolio. So I'll be chatting a little bit about who we are, the team, and then I'm going to chat about the innovation portfolio. Michelle will come in and chat about the global equity portfolio, and then I'll end with our multi-asset strategy that's also geared towards growth. Matt, if you can go on to the next page, that'll be great. So Matt's already explained this, who we are. We've actually been in business for 125 years, so we think we've got some experience in this field. And What's quite interesting is we're one of the few of our kind left in South Africa. There aren't many, private stockbroker companies left that interact closely with their clients and provide that bespoke service. I'm not going to go into depth here because we are short of time. Matt, if you can go on to the next page. Again, this is just our philosophy. We definitely are client-centric in our approach. I'm not going to go through how we look at that, but long-term returns is what's incredibly important for us, and obviously aware of risk and so on. Matt, next page, please. Well, this is who we are. This is just the Pretoria team. Saspen's got teams all over South Africa, but you're chatting to Michelle and I, and we form part of that Pretoria team, and we are supported by these three amazing ladies who really help us and form the backbone of our business. Both Michelle and I have got 16 years experience, and we've actually been at Saspen from the start of our careers, which is quite interesting and unique and very important to us. We've built the business up from nothing to where it is today. Next page, please, Matt. All right, we're going to talk about the innovation portfolio, which I'm quite excited about. This is a fully offshore solution. It is purely in equity and listed ETFs. And it essentially tracks the world as we see it in the future. It really tracks a growth-orientated approach. Matt, if we can go to the next slide just to describe how we view that. So the investment committee, we all sat down quite a few years ago, and we had a thought of, what are the trends and the themes that are driving global growth? And we picked up 3 major trends, and underneath those we nominated a number of themes. And I know it sounds pretty obvious, but it's really difficult to articulate some of these matters. So here's a good description. So trends, urbanization. There's absolutely no doubt that more and more of the world population is moving into urban city centers. We have a growing population, but very importantly, that growing population is also aging as well. We are living a lot longer. We're not necessarily living healthier. It's an important trend to identify. And then we do have a rising middle class. Countries like China and India have increased their middle class substantially, and that has a huge impact on the themes that we have here for the innovation portfolio. And those themes are pretty straightforward. You've probably heard about these all before, but we've nominated these as the growth area for the future, and where we would put money on a high growth offshore trajectory. What's interesting, and this feeds back to Anil's introduction, is that none of these themes or these trends are investable in a local environment. None, unfortunately. It would be wonderful if these companies existed locally. They just don't. So we have to access global markets in order to gain opportunity to invest in these themes. So remember, Saspen's viewpoint on investing overseas is not because we're worried about, rand fluctuations or deeply concerned about political, situations and so on. Those are all things that we understand and probably all agree on. Our main role for shifting our clients' money offshore is to gain access to the opportunities that exist there that just do not exist locally. That is the first reason. If you're then covered by geopolitical risk and rand fluctuations, well, that's just an added benefit. So once we've determined these themes, the ones below, the ones in the little gray circles, we would then go out and actually have a look at the companies that are exposed to those themes. So we spent a huge amount of time and effort having a little bit of a bottom-up approach here. And let's take, for example, healthcare innovation. Now, under healthcare innovation, it's a very broad theme, but we wouldn't necessarily choose a Johnson & Johnson or a Roche, which are technically healthcare innovation companies. We would have a look a little bit more specifically at, say, gene therapy. We believe that's a great growth area. And we would go out and we would pick a company within that area that we would feel would be the best exposed. And then underneath that, we would actually include an ETF or an exchange traded fund that will give us exposure to all of those companies. It's very difficult to pick the best company within a field. We will try to do that, but just to cover ourselves, we would also include a ETF. Under smart mobility, as an example, we just couldn't agree or pick on a company that we would feel would do the best in that area. Therefore, we felt comfortable picking an ETF that would be exposed to lithium and battery technology. Tesla certainly was an option. We just don't necessarily feel that Tesla will be the winning company over the next 3 to 5 years. We believe it could be something else. But we would hold an ETF that would include Tesla, as well as many other companies that the media are not necessarily familiar with that would gain exposure to that space. Under 5G and the Internet of Things, we actually looked at buying 2 specific companies. One of them is Iridium, which probably none of you have heard of, but Iridium is really the leader in its field when it comes to phone to satellite technology, which might sound a little bit old school, but we need to understand that satellite phones are still used prolifically by the military. In fact, the US military is their biggest customer, and then used all the time by shipping. Remember, ships go out into the middle of nowhere where there are no cell phone towers. They need to communicate with each other, and they usually do that via satellite technology. Same to do with airline industry as well. So that's just something that is quite interesting. So these aren't necessarily first tier technology companies. Some of them are, like Iridium is first tier in its class, but you would get second and third tier businesses in this space. I'll leave you with one interesting thing on the cloud computing and cybersecurity. We actually quite like a company called Digital Realty, which is actually a property business, but they specialize in properties that are only exposed to your computer banks or your data banks, these buildings that are filled with servers that exist throughout the world and are just an absolutely huge prolific growth area. So it's not a company that would be retail based or office based, but it would be purely exposed to the concept of cloud computing and the returns that we are expecting there. Of course, this all sounds interesting, but what have the returns been like? So Matt, if you can go on to the next page, please understand that this is Sasfin's highest risk profile portfolio as well. It's not necessarily for the faint-hearted, but we as portfolio managers love to include it as a sweetener on our offshore portfolios, almost adding a lot of alpha to the portfolio. So these are all US dollar-based returns. The portfolio has been in existence since early 2016, but the last 3 years we've managed to generate a return of just over 31% in US dollar terms. What does that mean? Well, that means you've basically doubled your money in less than 3 years. The last year was exceptional. We did a 74% return in US dollar terms, but that's on the basis of a recovery from a very oversold level due to the COVID kind of black swan event that we saw. It is a volatile portfolio. We need to understand that it's not always going to be sunny, shiny days. We have had a little bit of rain. The portfolio has sold off a bit. There's been a bit of a pressure on your tech stocks. So we are down 7% in the last 3 months, but are back up to 2.6%. So we like to, target higher returns of this portfolio because it does come with a higher risk. But so far, so good. We are incredibly happy with the performance of this portfolio. We do need to balance that, though, with the general equity portfolio, and I'll be handing over to Michelle, who will run you through our Sasfin Global Equity Portfolio. Michelle, I'm going to mute and turn off my video, and you can continue. Thank you very much.
Thank you, Nicholas, and good evening to everyone. What I'll be talking about is Sasfin's Global Equity Portfolio, and that is our pure equity portfolio or solution, as you would like to call it. It's an actively managed fund, and the fund manager is actually Bruce Ackerman, and he is supported by in-house portfolio managers as well as our research team. You can go to the next slide, Matt. I think this also talks to what I'm going to say. The portfolio currently has exposure to 27 companies, and the mandate allows for a minimum of 20 and a maximum of 30 stocks to be exposed to. The benchmark that we've chosen for this portfolio is the MSCI All World Country Index, and that index tracks 3,000 companies in over 49 countries. So it is quite large. The investment objective of this portfolio is to consistently generate positive returns over the long term, and we do that by selecting the best companies in the world. The portfolio follows a top-down approach, a theme approach, as one would call it. And after that, we also follow a bottom-up, as Nicholas has referred to in his presentation as well, to actually selecting the companies that best complement these themes that we would like to invest in. The portfolio is also designed to have a lower volatility than that of the benchmark. And at the moment, the portfolio has an average standard deviation of 11% lower than that of the benchmark. What does that mean? That means we have better valuation metrics. We thus have the opportunity to select higher quality companies at better valuations. Now, on this page, you will basically see some of the top 10 stocks that we do invest in. And I'm sure most of you would be familiar with an Alphabet or a Google, Walt Disney, Amazon, Nestle, Roche. Nicholas has mentioned Roche as well before. That is one of the companies that we do consider in the medical space as well. You can continue to the next page. I'm going to be very quick on this one. However, as it was mentioned before as well, everybody would like to see the performance. How has the global portfolio actually performed? Now, what you can see is the theme-based approach that we follow is actually a winning formula. This portfolio has consistently outperformed the benchmark over the long term. And this portfolio also started in the early January 2015 level. So just over 13% per year annualized in USD terms. What is very interesting on this specific slide is also just to compare it to the local markets as well, to see, and I think Anil, in your introduction, you also mentioned this. So very important to see how you could have created value by actually taking money offshore. You will also notice that the 1 year performance, what has happened there, as we all know, you can see it clearly on the graph indicated as well. And this is the reaction to the markets in the past year to the pandemic and the surprising quick recovery thereof. So why has the benchmark outperformed the portfolio over a 1 year period, keeping in mind that our focus is absolutely long term? But just to put things in a little bit of perspective, we have a cash allocation of roughly 5% in the fund, the actively managed portfolio, versus the benchmark that had a zero allocation to cash. Our exposure to the healthcare sector through the likes of Roche and Medtronic also lagged the market in general, and that was due to the economies going back into lockdown and elective surgeries actually being postponed for the moment. We are, or at the time rather, we are of the opinion that companies that are involved with the medical sector will, however, play catch up as soon as these economies start to open up again and people start to realize that they need to go for those surgeries. So there's a lot more to say, but unfortunately we're running out of time. So Nicholas, I'm going to hand over back to you. Thank you, guys.
Great, thank you for that, Michelle. I'm going to end off by chatting about our multi-asset approach to management. It's important to understand that it's not just all about shares and just getting the maximum amount of growth. You need to balance your growth with understanding your risk. So we do have a growth approach, but we like to bring in different asset classes that we can expose our clients' money in to just balance the volatility that one can experience on the stock exchange. And we do that by accessing other listed asset classes that might not be as familiar with the investor community. I think in general, we tend to consider the traditional approach of cash, bonds, or equity. And we tend to forget that there are other asset classes, such as real asset classes, which would include your commodity exposure, your property exposure, and what we would call your infrastructural exposure, with that of alternate asset classes, which would be your absolute return strategies and your listed private equity. So Sasfin has created a portfolio that exposes the solution or the client not to just 3 asset classes, but up to 8 asset classes. And those are the asset classes that are described there. I've just mentioned a few of them. There are others as well, but you would have equities, fixed income, private equity, real estate, commodities, and infrastructure within the portfolio. What's important to understand is the strategic asset allocation to those asset classes that actually project about 80% of your return. In other words, it's the mix of the asset classes that you have in your portfolio. And if that mix is correct, literally 80% of your job is done. We're looking at obviously capital appreciation over the longer term, but that capital appreciation balanced with a significantly lower risk than the market. Hello?
Can you start wrapping up, please, man? Thank you.
Yeah, will do. Well, let's go on to the performance of that portfolio then. So that'll be the next page, Matt.
Next page.
There we go. Great. So our benchmark is the US CPI plus 5%. That's what we would consider a decent amount of growth over the long term to achieve. We have firmly done above that. Therefore, from a lower risk perspective, we are able to produce just under a 12% US dollar return on an annual basis. The key with these three portfolios is to actually use them in conjunction together to create a very powerful solution that would give you a very good mix of return balanced with a lower risk outcome. Thank you very much for your time. Matt, I am done. I think we can continue. Thank you.
Awesome. Thanks so much, Nicholas and Michelle. We appreciate it. Very good presentation. So yeah, lastly, we have HiSec. Just to give you a little bit of background on HiSec. HiSec is a niche wealth management and financial services company. They've been in the financial industry since 1982. So they've been around for some time and they've seen many changes over the years. They've also maintained their relevance, and through the extensive experience, they continue to learn and adapt to the ever-changing world around us. HiSec aims to create private wealth management experience for their clients. With us today, we have Stian Pretorius, who is one of the advisors at HiSec. He's a chartered accountant and has been in the financial industry service since 2002. HiSec is also a founder member of FinSelnet, a strategic investment association. And Stian also serves on the board of this association and is at the forefront of the key thinking on the industry, new developments and strategic planning in this regard. So Stian, I know we're running a little bit late, but you have some time to go through your presentation. Thanks a lot.
Thank you, Matt. I trust everybody can hear me. Thank you and welcome to everybody. We're in the home straight here, so I'll try and do this quickly just from myself. And HiSec, thank you very much, Anil and Matt, for the opportunity. We really appreciate that, and we hope we can add some value. All right, Matt, I think you can carry on. We don't need to harp too much on who HiSec is. You've given us an introduction there. We do various things, but tonight we're talking about why are we going offshore. And I know you guys have painted the picture nicely, but I thought this, how does the saying go? A picture paints 1,000 words. So this is just a nice summary for me to see. It's on scale. And so I get a question as to why many people focus on the US in terms of investments. And I mean, you can just see that currently the US is still the biggest in terms of most valuable brands in the world, followed by Asia. And then Europe is a little bit smaller, although they have an established presence. And then unfortunately, there's only one for the Middle East. And I'll give you $10 for who can guess that. So yeah, you can carry on. The point behind that is the US just gives us, not the US, the international market gives us a much better opportunity set to deliver returns, and all the previous speakers have spoken about that. But essentially, I'll cover what we offer, but I think just to give the attendees tonight just an understanding of how we access these things. Essentially, there's two ways to get offshore exposure. The one is you go out on your own discretionary allowance. That's where you go out in hard currency. So this is where you do what the Sasfin guys does in terms of their portfolio offering, or Valoop or Orbvest, because you need to go out physically. We can also do that, except we do it in unit trust portfolios. And I'll talk a little bit around that in a couple of minutes. Or secondly, you can stay in South Africa and you can access that offshore exposure via the asset manager's offshore allowance. There's a few differences there. Physical offshore out the country at this stage is only available for individuals, and you can only get access to that by taking it out in your discretionary allowance. In other words, your 0 to 1 million, or in your investment allowance, which is 1 to 10 million. That's per person, per annum. So you have essentially a lot of scope there to do it, but the limitation is you can only do it in your personal capacity. In terms of the asset manager's allowance, you can do it individually for in your own capacity, for your trust, for your investment company, or particularly relevant for us in terms of managing post-retirement clients' money is getting offshore exposure in their living annuities. There's no real limits here. We can talk about the limits in living annuities. I'm sure there's some attendees who've heard about the limitations issued by Alan Gray and 91 and Signia lately, but that's a discussion for a separate time. The real difference is one is domiciled in Rand and the other one in dollars. So I'm going to talk about the offer that we give on the discretionary portfolio physically out the country now, which is mainly available in dollars and in pounds. You can do it in euro, but the offering is slightly limited in terms of that. Essentially what we do, you can carry on, Matt, thank you, is physically out the country. We rely on various asset managers to give us exposure across various jurisdictions. And so typically we use 91 here, which is a well-known brand name or should be known in South Africa. They are the old Investec. They changed their name last year. And then probably less known is Morningstar. So Morningstar is the biggest research company in the world. They run specific model portfolios for us in the unit trust world. And I'll explain what a model portfolio is shortly. And then we access Fundsmith, which is a UK-based fund. It's domiciled in London and it's run from there. And you can see the type of fund that we have there. So Fundsmith is a British pound denominated investment. The 91 Global Franchise is a specific unit trust fund, which we utilize. I see it says UDS there. Apologies for that. It should have been US dollar investment. You can actually invest in the franchise fund in pounds also. And then we have the model portfolios, where there's basically 3 risk profiled funds. And so a model portfolio, just before you carry on, I just want to explain how that works. So the Morningstar model portfolios is essentially a fund of various funds. So for example, in the growth fund, we have 10 unit trusts. And what it does is it gives us the capability to move quickly between jurisdictions, and we can chop and change what and where we want. So for example, in the Global Growth Fund at the moment, there's about 45% exposure in the US, about 11 in the UK, 11 in the UK and another about 11.5% in Japan. So it just gives us some optionality and it's quick and easy to change. And obviously, depending on your risk appetite, you can pick and choose how much exposure you want to have where in terms of risk. We can run through the next couple of slides quickly. I just put them all on a summary. So this is the global cautious portfolio. I see most of the people here today spoke about mostly growth assets outside of the country. I would argue that's probably where most people will go, given the massive interest rates that we have of 0% in the developed world lately. So you don't really get much bang for your buck there. But you have the cautious portfolio, which has done really well. I wouldn't look at 1-year returns for now. I know we all have given you wondrous numbers in terms of 1-year returns, but I'd argue 3- and 5-year return numbers are more relevant to look at. These are all annualized. You can carry on, Matt, thank you. Next slide. So that's the balanced portfolio. So you can see that it's a little bit more muted in terms of return over a longer period, but better than the global balanced portfolio. So over a 5-year term, it's still giving you 10.3%. These are all US dollar returns as at the end of April. You can carry on. And then the growth one has done exceptionally well in the last year, like most growth assets have done offshore. These are also dollar returns. And over a 5-year period, again, 13% in dollars. You can carry on. This is the Fundsmith fund. This is in pounds. This is particularly my own favorite fund. I think these guys are phenomenal. I actually don't know how they do it. I haven't seen a 1-year return that's negative in pounds. Even in 2018, when we had the massive re-rate in December, they still had a positive return in pounds. They are phenomenal in what they do. So you can see there they've got an 18% return over a 5-year period in pounds. This is the franchise fund. It's just a little bit of a different way of showing it to you, but you can see over a 5-year term, it's done 13.6%. This is dollar return. I really like this fund also because it's completely different to what a lot of people are speaking about in terms of growth. They are more conscious towards quality and more conscious towards less risk, even though it's an equity portfolio. They do the stuff that we all use. When you wake up in the morning and you brush your teeth, you're going to use something of Johnson & Johnson to use your toothpaste or your your facial cream or whatever, and they hold Johnson & Johnson, and then you go have some cereal and they hold Nestle or whatever you need to do. That's the kind of stuff that they hold, real quality companies. And you can see that even over an extended period of time, they have delivered 13.6% over a 5-year term in dollars is a phenomenal return. So you can carry on. Thank you, Matt. So the question for us really is more important in terms of, yes, fund management is important, model portfolio is important, unit trust is one way to do it. But what we typically do at HiSec is from a physical offshore point of view, we try and wrap your investment when it gets to physical out the country. So you can skip this slide. Thanks, Matt. The real question for us is, why do we want to do that? So you can see that there really are two ways to do this. And this is a little bit of a busy slide, but essentially you can see that you've got a global investment portfolio, which essentially is just a direct investment. And then you have a life portfolio, which is wrapped. So the difference is, there's a difference in contribution, a difference in liquidity, tax benefit, and then estate planning. So for us, the real benefit lies in the last two, although we get around contribution and liquidity. So I wouldn't worry too much about contribution and liquidity for now. We can discuss that at a later stage if people want to understand them. But really what it does, it gives you real tax benefits upon death, and it gives you real succession and estate planning benefits at the same event. You can carry on, Matt. You can skip that 120% rule due to time. I'll explain that to whoever wants to understand. Essentially what this does is, if you have a direct investment offshore, like for example, unwrapped, you're looking at that yellow or orange line, depending on the screen quality that you have. So if you've invested $100,000 in 2019, and I've just put this, I think this just assumes that you've gone into the 91 franchise fund. It's just a way to explain this to you. And you die in 2033, 2034, then essentially what will happen is you'll need to pay executives fees, capital gains tax, and estate duty if you're a South African tax resident. And because of that, you're going to lose a massive amount, and you would have earned $209,000 after tax on your investment. Nice return. But if you had just done nothing other than wrapping it at the same cost, you would have avoided executives fees, and you would have avoided CGT and only paid estate duty, giving you almost a $50,000 return additional. No, there's no change in the underlying investment performance. So it's important that you understand these things, and this is what we prefer to do. We prefer to do that with 91, but you can do it in various places. We can do it with Glacier, with Momentum, and even still utilizing these model portfolios that I've spoken to you about. You can carry on. So just to summarize that, why do we use a global life portfolio? It's exempt from income tax in South Africa. It gets taxed in the wraps. You don't have to worry about declaring income to SARS. Your CGT is capped at 12%. And I know we're speaking to some high net worth individuals here. So if you had that investment portfolio directly in your own name, you'd have paid tax at 18%. It's exempt from probate, assuming that you've nominated a beneficiary. This is very important. I'm still struggling to fix or finalize an estate which we're managing now, who has where the deceased had assets in Germany. It's been coming since 2017, and we're just unable to finalize it. Exempt from CITES tax, exempt from CGT, exempt from executives fees, and obviously if it goes to your spouse, then there's no estate duty. It is still fully liquid, and I'll explain that to you, and anybody can take ownership, even including an offshore trust. And for me, this is important. If you're going to go the whole route of taking money out of the country, applying for your tax certificate, getting it out, then why would you want to be in a position where upon death, your executive is going to be forced to bring that money back into South Africa? So for us, this is an important way to do that. This does not affect the actual underlying unit trusts that we invest in. It's just a vehicle through which we access this. So this is an important consideration, and I'm happy to explain anything on this if anybody has questions. You can carry on. So that's really the discretionary allowance. You're taking your money physically out the country, you go buy the dollars. The other way to do this is get offshore exposure in South Africa. And really, I would argue the limits in terms of investments are probably the first hurdle here. So if you want to take money physically out the country, some guys want to look at about $25,000 as the minimum investment. That is the set rule for us. We can negotiate that down probably to 5 or 10,000, assuming that there would be additional contributions coming again. But there is a bit of a hurdle from a costing point of view also to get your money out of the country directly. However, if you want to just make sure that you get offshore exposure, you can do it in Rand and you go out on the asset manager's allowance. This is available for individuals, for your trust, for your investment company, and particularly for people who have living annuities. So there's no limits here, and we access it via the asset manager's portfolio or asset manager's allowance, but this is domiciled in Rand only. So you can carry on. Here, I won't spend a lot of time on. We have a portfolio which we've built and back tested numerous times over the last 5 to 10 years. And essentially, we make some changes to this. But again, this is a house view portfolio where we use some of the net group investments, Coronation, again, Fundsmith, again, 91. But we bring some tilts in terms of theme in here. So for example, at this stage, we're using the Signia Fourth Industrial Revolution Fund, which essentially tracks about 300 companies in the US. It's done phenomenally well. There's another tilt that we're starting to employ, which is really the health innovation fund tilt. And I see Sasfin has also spoken about that. And really, we just model this on your risk appetite. And as a standard example, you can go to the next page and I'll show you what this has done. It's a little bit of a busy slide, but really what you need to look at is if you go and look over a 5-year term, the very left bar versus the very right bar. So the very right bar is the MSCI All World return. So if you're going to look at a 5-year term, just putting your money into an index would have earned you 13.3%. Whereas this mix that we have employed has given you 18.2% compound per annum over a 5-year term. And you can see that at every stage, which is important except for the last 1 year, where we're pretty close, we've beaten the index by compiling this house view. And we do a lot of work with Morningstar as well as with Signia in the background, where we see them regularly and try and make sure that we are on top of the curve. So Matt, I've tried to rush through this a little bit to keep to your time limits. I see we're slightly over. I have really done this quite quickly, but there's a lot of work that we do in the background. When we speak to the asset managers, we see them every quarter. And I'm in the fortunate position to have direct access to them. And I think that's a really important thing that people need to understand is we don't try and just follow the dartboard approach. We try and understand what people do and what the asset manager's thinking is like, and then we have regular interaction with them to make sure that we achieve a set outcome.
Awesome. No, thanks a lot, Stian. We know how good you guys are. That's why we use you. So thanks again for the presentation. I think just for a matter of time, I don't want to keep the questions and answers too long. If there's any questions, you guys I haven't seen any in the question box, and the one that has been posed has been answered. So if there's anything else, I'll provide for a minute or two, and we'll wrap up from there. If there's anything where any of the attendees would like to contact us or find out more information from any of the panelists, you're more than welcome to contact us. Our details are on the screen. And yeah, thanks a lot for taking the time this evening. Anil, just to end off from your side, I'm sure you want to say something.
On the Q&A, there were a couple of questions that was
Anil, I think you're muted. Just unmute yourself. There we go.
Apology. Yeah, no, maybe quick answers from the panel. There was a question from Stephen. How does Justin at Obvious find properties for sale in the particular states? Maybe a short 30-second answer for some of the questions that were asked.
Thanks, Stephen. Yes, answer to that question is we weren't naive enough to think that we knew everything about the markets we went into. We found the leaders in that particular area and we partnered with them initially. I must say the model has changed. We now have properties coming to us. And I think also very important to understand that you can't buy properties on the open market because you pay a premium.
Mm. Yeah, a fascinating strategy, Justin. Good luck with it.
Thanks, Stephen.
Yeah, the next question was raised regarding the private equity side with Valoop. Stephen or Chris, would you like to just share the answer on why your model
Yeah,
is much different.
we did respond to that. So it's an experienced investor fund regulated in Gibraltar. So that typically has a 100,000 minimum euro, but if you come through a professional advisor, that can drop to 50,000 euro. Clearly, that's excluding some of the people mentioned, wrappers and nominee services, which would change because that would aggregate it on the nominee service. But if you came in directly, it would be 100,000 generally, but if you came through a professional advisor, it would be 50.
Thanks, Chris. I think HiSec has already alluded the minimums, so $25,000 if you go direct offshore, and if you went via a company or a trust, you could do smaller amounts. You can engage with us on that. Nicholas, you want to just give a quick idea of your minimums, please?
Yes, certainly. So remember, Sasfin is offering direct exposure to offshore in a bespoke nature, dealing with a stockbroker. Therefore, our minimums are set at a higher level. We do not feel comfortable taking anything less than R1 million offshore at a go. It's about 70,000 US dollars as a start, but preferably we would like to build up on that. And for a correctly diversified portfolio, we would be more comfortable with $150,000 and higher, essentially. But to start a portfolio, $70,000 is what we would take as a minimum. Thank you.
Cool. And then there was a question raised on the liquidity side. Thank you, Nicholas. Sure. Thank you to all the presenters. You all did amazing. I apologize for being a bit over. There was one question on liquidity. So obviously, Obvious and Loop has lesser liquidity. Do you want to have a quick comment on that, and maybe on the Sasfin and HiSec side, liquidity of your portfolios, please? Quick answer on that.
Well, let me start on the Sasfin side, if I may. All the solutions and the portfolios are all listed on global markets. They're all vetted, and the positions are all highly liquid. It's one of the risk measures that we consider. So getting into investments and getting out of investment, is incredibly quick for us, essentially. So liquidity is not a problem at all.
Thanks, Nicholas. And if Stian can comment on
Sure. Our space is essentially a listed space. There's a little bit of a private equity underpinning some of the money that we have in South Africa, especially in the Signia fund, but it's fully guaranteed by Signia, so you won't have any issues there. So it's fully liquid. On the SA side, in other words, invested in Rand is very quick, 2 to 3 days. Offshore money physically out the country, you can bring it back, absolutely, no problem. It's 100% liquid. The only issue is time to repurchase, convert back into Rand if you want it here. If you want it offshore, it can pay anyway. So assuming that it's in your own bank account, of course. Know your client and figure.
Yeah. Thanks, Steve.
He's the beast.
Can you just comment on the income that generated here, quarterly, and when it's paid, and also the liquidity of the value and what?
Certainly, Anil, I think I lost you at the end there, but just to repeat, on, for example, the ODH, the diversified product, we pay 7%, but we pay it out quarterly, 45 days after the end of each quarter. And we drop it into an account in the Seychelles. Obviously, it's a tax-free environment. And we use the merge exchange, which is the Seychelles Stock Exchange. So it's kind of a very clever way of making sure that it's efficient as possible. The money stays there until you want to use it, draw it out, or reinvest it. So I think that answers the question. Anil, did I cover it 100%?
Yeah, and just in terms of the time frame on the capital side, please.
The time frame, well, we open for ODH4. I'm not sure I quite understand the investment.
In terms of liquidity, just the time frame on the capital side.
Sure. So although we are very careful to make sure that people understand that we are selling a 5-year product, I think it's understandable that this is a product that is actually tradable on the exchange. So if anybody does want to sell their shares, and we have had quite a lot of people, especially over the last year or so, that circumstances have changed. We have always been in a situation where they have got back their capital, and bear in mind they would have had the 7 or 8% interest in the meantime. So the current situation is, yes, there is some liquidity. The buyers always come from the existing investment, and as I say, generally it's dollar for dollar. You might get a little premium, but generally dollar for dollar.
Okay, thanks, Justin. And maybe Chris, if you can just share on your side, on the Valoop side, you know, the
Stephen, I don't know if you want to cover that question.
And the liquidity after year 3, exactly how that works.
Yeah. Stephen, do you want to take that?
It's not a great signal here, so I think it was on the liquidity, because we have the full stack of all the financial products: asset finance, debt, mezzanine, mortgage, private equity, and surety. Because we've got the whole stack, we're able to use the debt product in these SME acquisitions to a reasonably decent level. So the capital that we use to acquire the equity actually comes back to us as debt monthly plus the 10% yield. And we have a liquidity policy that scoops up some of that capital and builds a liquidity reserve. So the liquidity reserve comes from the products that we use, not from an exit. And it's more stable, it's predictable, and it's constant. So we don't want people to exit after 3 years at all. That's not what the product's about. It's a long yield return and long hold. But if they really needed to, they could exit after the 3-year lock-in period.
Sure. Thanks, Stephen. Just from a time, we're quite over, so I want to say, Matthew, if you can just close up. So from my side, I want to say thank you to all the panelists. Thank you for all our attendees. Hope you found it valuable. And yeah, if you have things that you need clarity on, you're welcome to engage with us or the company directly. So yeah, keep in touch. Matthew, if you just want to close, thank you.
Thanks, everybody. We appreciate it. I think Cornelia said it. Jesse, if you can just end the meeting for all, and should anybody want the recording, we'll be happy to send the recording out. Thanks a lot, everyone. Thanks, panelists and attendees. We love you guys. Well, have a good evening further.
Thank you.
Thanks all. Have a good evening. Bye-bye.
Thanks very much, everybody. Good night.
Jesse, if you can just please end the meeting for